Tax season is here once again, and as always, there are some changes from last year just to keep us all guessing. Today's guest has some advice how to prepare your taxes and hopefully save some money. Kent Prestage has decades of experience preparing taxes, and he is the owner of Prestage Consulting and is also an instructor at Reeves College in Lethbridge. Kent, great to have you with us again.
It's great to be here.
So first of all, when we do personal taxes, we need to be they need to be filed. And what is the penalty if you end up being late?
Well, if you don't owe any money, and that's about 80% of the people don't owe any money, but if you do owe money and you're late filing, it's a 5% penalty right away. So like for 1 day late, it's 5% penalty of the taxes that you owe. And if you wait, every month they add another 1% on top of that. So you don't want to be late filing if you owe money. If you don't owe money, well, there's no fine for being late.
And for those of us living in Alberta, we just heard in the spring budget that the tax rate for those making less than $60,000 a year will drop from 10% to 8%. Just to clarify, is that for this year's tax filing, or will we have to wait until next year's tax year?
Yeah, it's for this current year that we're in. So when you file your taxes next year, the average person will get about $750 less provincial tax that they have to pay. So for a couple, that could be $1,500, which is pretty nice.
Yeah, and many people today simply just use tax software to file their tax returns, but sometimes it may be worth hiring a tax professional to do the preparation. Why is that?
Well, I guess basically you don't know what you don't know. Just give you a little story about that. I had one of my clients, well, this was about 10 years ago, say to me, I want to do mine using a bought in the store software, and then I want to compare it to what you do. So I said, okay, go ahead. He filed his taxes. Then he gave me the same information, and I filed, or I filled it all out and did all the work, and I got him $1,500 back more than what he got back himself. Now the reason was he didn't know what he could use for deductions, and I did. So in that case, like I said, you don't know what you don't know. And in his case, I mean, he was still going to get money back, but he got a lot more money back by using a professional.
So what are some of these commonly overlooked deductions?
Well, in his case, he was a pastor, so there was a lot of different deductions that he had overlooked. He had picked up on the clergy allowance or housing allowance, but he had missed a number of other deductions that he could get for mileage and things like that. So, and that was what he had missed. Now, what are some of the most common things that people miss? Well, there's so many I can't even begin to talk about what people miss. I mean, even sometimes on T4s when corporations are filling out the T4 for their employees, sometimes they make mistakes on them too. The most common mistake is on the amount that for CPP and EI. So uh, even businesses make mistakes. So.
And there was quite a bit of pushback this last year when the federal government announced it would be raising the inclusion rate on taxes for capital gains in excess of $250,000 for individuals, as well as for capital gains realized by corporations and most trusts. Is that still the case, or did the government back off on that?
Well, of course, during the Liberal leadership campaign, a number of the people that were running said that they were going to go back on that and not do it. Carney, who won, he has said that he's going to completely back away from it. What the party did, or what the government did in the meantime, was they set it aside for a year. And as soon as Carney gets in, he's promised that he's going to backtrack on that tax. So, and I'm happy about that. I think I don't believe in taxing the population any more than you have to. So.
Definitely, that's the case in Canada right now. But there are some changes for Uber drivers, online tutors, and e-commerce sellers. What do they need to be aware of?
Well, up until now, they self-reported their income, but the government is now forcing the Uber company to keep track of the income that the drivers make. And then that money, that amount is going to be reported directly to the CRA. So I suppose there was probably a lot of people who weren't reporting that income. Now you won't be able to not report the income. It'll go straight to the CRA, and you won't be able to, you have to report it anyways. But
But if you're like an Uber driver, or say like you're like a food courier, like for like Just Eat or Skip the Dishes or DoorDash, like aren't you considered self-employed and you would have to self-report anyways?
yes, but they found that too many people were cheating. So that now that information goes directly to the government on the income side. Of course, you'll still have your expenses that you'll have to report and stuff too. But on the income side, the government's making sure that nobody's hiding their income.
Gotcha. Okay, and I'm told that one tax credit that is often overlooked is the disability tax credits that families can claim for children if they qualify. Can you explain how that works?
Yeah, the disability tax credit is actually a very valuable credit. You can get $9,872 for a person, and if they're a child under 18, you can get an extra $5,788. The key though is that you have to fill out a form. It's a T2201 form. You have to fill that out before you file your taxes. And then it has to be filled out by a doctor. So you have to be quite disabled. It's not something that you're going to get, if you're just slightly disabled. You have to be quite impaired to qualify for it. But if you qualify for it, it is a great credit. And if you have been taking care of somebody for the last 10 years and you didn't claim it, you can claim it back for 10 years. So it could be a substantial amount of money. I've had clients that have got back in excess of $30,000, $40,000.
Wow.
So it's well worth it if you qualify. Qualifying is not easy though. Like I said, and the form that I'm talking about, it's not a two-page form. It's like a small book, and it has to be filled out by a doctor. So, and then it has to be approved by the government on top of that.
And I understand that there is an opportunity for first-time home buyers with the FHSA, the First Home Savings Account, to save up for a down payment. Are there potential tax implications when you buy or sell a home?
Yeah, well, this is a program that's been brought in. It's very similar to the RRSP, so people are familiar with the RRSP. A few differences, but the principle is the same. You put away money, they give you a tax break when you put it away, so you're putting away before tax dollars. And then when you take the money out, you don't have to pay tax on it at all if you buy a qualified house. It's got a lot of strict restrictions around it. You put away $8,000, but you can only do that for 5 years. So you can put away a total of $40,000. And then within 15 years, you have to use that money to buy a house. Or if you decide not to buy a house, you can roll that money into an RRSP as long as you have room for it. So it's a really good deal. Go
So,
ahead.
so you say when you buy a qualified house, what's a qualified house?
Well, it's basically there's a number of qualifications. Any house that you buy, the qualifications are that you can't have owned a house for 4 years prior to that. But any home that you buy that's a house, you can certainly use the money for that. And as long as you own the house, or even if you sell it in the future, you don't have to pay tax on that $40,000. So it's quite a substantial savings. I wish they had it when I bought my house. So.
For sure, and as always, there's the option of borrowing against your RSPs to purchase a home. Any changes with that recently?
Nope, that's still in there. You can still borrow against your RRSP. The trick there is, though, that you have to pay it back over, I think it's 11 years. I'm not sure on the exact number of years, but you have a number of years you have to pay it back over. And if you don't pay it back into the RRSP, then you have to claim it as income a little bit every year. So it's not quite as good as the one that's specific for houses, but still, boy, today $40,000, it's a down payment, but barely, if you know what I mean. So it doesn't hurt to borrow from your RRSP, and you can do both. You can have the home product as well as borrow from your RRSP. So, and again, the more money you pay down, the less interest you pay. And when I was going to school, they used to call compound interest the eighth wonder of the world. It can either work for you or against you. I prefer having it work for me, so I like to save money, and then pay as little of interest as possible.
Now, you said that the majority of your clients get tax refunds, and these clients are Christians, and you said that it's because of charitable tax donations. So let's talk about that. How beneficial is this, and how much would it save you on your taxes?
Well, it can be very beneficial, actually. The only one that's maybe a little bit better is if you give to a political party. The politicians take care of themselves, right? But for donations to a church or to any charity, the first $200, you're going to get 15% back federally, plus you're going to get the same amount on your provincial taxes, not the same amount towards your provincial taxes. So you're going to save about 25% if it's under $200. If it's over $200, you're going to save 29%, and closer, depending on what province you live in, that would be closer to 50%. So it's well worth doing. I mean, it's really a blessing for those that take advantage of it, because not only do you get to support your favorite charity, you also get a tax deduction for it.
Awesome. And what about childcare expenses? Can we deduct those?
You certainly can. If your child is under 7 years of age, you can claim up to $8,000 for each child during the year. If you spent that much, you may have and you may not have. And of course, anytime you can save money, save taxes on money that you had to spend anyway, it's going to be an advantage. So.
And how long should a person hang on to their tax documents? Like, is there like a set time, like a year, 2 years, 5 years, 10 years?
No, actually, the government has strict rules around that. You have to hold on to your records for 6 years. And I always tell my clients 6 years plus the current year. So I really stretch it to 7. After that, you can get rid of your records. Income taxes are actually statute barred, which means that the government can't go back more than 3 years unless they find something wrong. If they find that you've cheated or you've done something wrong on your taxes, then they can go back further. But otherwise, they can only go back 3 years. So, but then keeping your records for 7, just in case they want to argue with something.
And any final advice for someone that is filing their taxes on their own or using tax software?
Well, make sure you don't miss any slips. Probably the biggest corrections or adjustments that I have to make is somebody comes in later with a slip that they hadn't received yet. So I always make sure you've got all the slips that you need, and then go ahead and do your filing. If you're filing it on your own, there's a tax guide that Revenue Canada publishes. I would recommend that you take a read of that so that you've got a pretty good idea of what you can and cannot deduct.
And for those that are like shopping around for someone to file their taxes on their behalf, what questions should they be asking?
Well, first of all, how much are you charging? Because you want to know what you're paying. A lot of preparers will file your taxes, and then they'll give you an immediate return. They basically pay you, and then they get the money back from the government. Of course, they take some money for doing that service, right? So watch that. And today, there's hardly any reason in my thoughts to do that, because when I file somebody's taxes online, they usually have their money back in their bank account with less than 9 days. So if, say, a tax filer charges you $30 to give you a check today, that's really high interest. Just wait your 9 days and get your money back from the government and save that fee that they've charged you.
Kent Prestage is the owner of Prestage Consulting and is also an instructor at Reeves College in Lethbridge. Kent, thank you so much for your time today.
Well, thanks for having me.
I'm Naveen Day on behalf of all of us here at Bridge City News. Thanks for watching.